And welcome back once again, options traders. Well, I get asked a lot from traders, get emails and text messages, people saying, should I take this trade? Or is this a good strategy? Is this a good stock to enter now? Well, it's a really impossible thing to answer without knowing this one question. And this is one of the more important videos you can watch, especially if you're new. So before placing a trade, there is a question you should ask yourself. It will make the decision process so much easier. So what is the question? Let's go find out. And as always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So let's start with the common approach, the way that everybody approaches the market. Traders want to find easy money. And so, for instance, I'll say, well, let me sell naked puts, and I'll sell them out of the money so that they have a very low probability of going in the money. Or they may buy vertical spreads but widen out the strikes to make more money. But the focus is on high probability for making small amounts of money, or a low probability for making a lot of money. And they rarely consider the risk. Well, what's the question to ask to figure out if it's a good trade for you? Well, it's very easy. The question is, how will this trade help me accomplish my goal? Remember that you can't even define risk without a goal. So if you decide to, let's say, sell an out of the money put for 30 cents, ask how is that 30 bucks going to help you? How is it going to help you accomplish a goal? Now, maybe it does. Maybe your goal is to pick up nickels in front of bulldozers and see how long you can survive. I'm not going to tell you that's a bad goal. I'm just going to tell you what you're up against. The thing is that when you're doing this, selling these out of the money puts for pennies, you are still subjecting yourself to virtually unlimited risk. And wouldn't it make more sense, at least in some cases, to maybe use vertical spreads? Remember, you can make them 5, 10, or 15 or more points apart. So always remember that your goals are profits over time, subject to acceptable risks. And unfortunately, most traders look at absolute risk. They just say, what is the absolute probability of making or losing money? But they don't consider what's called the expected value. What happens after repeated exposure? What happens if I do this over and over? So let's say that maybe you sell this $100 put here out of the money for 30 cents or 50 cents, anything. Yeah, the stock might be way up here, and you're thinking, oh, I've got all this way to fall, and I can still make my maximum gain. Let me go grab the free money. But if you're doing that, you're also not realizing this unlimited tail out here. You have a negative expected value in the long run with this strategy. Why? Because remember, that's the whole idea of option pricing. If you're selling an option for, let's call it 30 cents, you're expected to break even in the long run. But there's going to be those moments that you're going to have this huge precipitous drop in the stock, and now all you've done is picked up a pile of pennies, and you get one trade that's going to keep you buried forever. So instead of just doing the naked puts, what if you did, for example, a vertical spread? So in this case, we've got the 125, 120 vertical spread, maybe with the stock down here at 115. But do I really need that kind of profit to meet my goal? Well, if not, let's increase the probability. Let's bring the strikes down, maybe the 115, 120. Looks like we're paying or have the maximum loss of just over a buck, maximum gain just under 4. Is that necessary to meet your goal? If not, let's make it a higher probability trade. And I'm going to just search the vertical quote board and keep looking to lower and lower strikes like this to find out what's going to meet my goal. And if I can find maybe this 100, 105 put spread, could be a call spread, but most of the time traders like to sell, in this case, the 105 put spread. And if that's going to meet my goal, look at this. I've already got both legs out of the money, far out of the money. Or if it's a call spread, both are deep in the money. I've got a much higher probability for making this $1 gain while still limiting it to a $4 loss. Now, once again, I'm not saying that's necessarily a good or bad risk-reward ratio. That's something that you have to come to terms with. But always remember that the higher probability, there's going to be a bigger cost, or a bigger potential loss and a smaller reward. That's just the risk reward relationship. But the thing that I find that traders never stop to ask is, which of these helps me meet my goal? So notice in this picture, even with only a few strikes, there are many vertical spreads from which to choose. So don't take more risk than is necessary to accomplish your goals. And to do that, you must understand just how many choices you have. And that's where options can really help you with your trading. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.